All right, let's talk about something huge. We're going to break down how to start investing in your 20s. This is one of the most important skills you can learn, seriously. We're talking about building real wealth, even if you're starting with basically nothing.
So let me ask you something. Does this sound familiar? Your salary comes in, and then, poof, just a few days later, you're wondering where it all went. If you're nodding right now, trust me, you are not alone. But hey, we are absolutely going to change that, starting today.
And this is why it's so critical to start now. See, if you're in your 20s, you have something that even the richest people in the world can't buy more of, and that is time.
Seriously, time is your superpower. It's this incredible force that can take small, consistent investments and just multiply them into crores. It sounds crazy, I know, but we're going to break down exactly how the math on this works.
Okay, but before we get to the fun part of making money grow, we've got to get a handle on where it's going right now. I mean, you can't invest money you don't have, right? So the first, most crucial step on this whole journey is actually pretty simple. It's all about budgeting.
And look, I know what you might be thinking. Budgeting sounds boring, it sounds restrictive, but forget all that. I want you to think of it like this. It's basically Google Maps for your money. It's not there to tell you no, it's there to give you a clear roadmap to get to your financial destination.
So, what's the simplest map to follow? Well, for most people, it's the 50-30-20 rule. It's a super powerful, really common formula that just helps you divide up your income with a clear purpose. Let's get into what that means.
It's pretty straightforward. Your income gets split into three main buckets. 50% goes to your needs. This is the stuff you absolutely have to pay for. Rent, bills, groceries, getting around. Then 30% is for your wants. This is the fun stuff, eating out, subscriptions, shopping. And that last 20%, that is the golden ticket. That's the money we're going to use for savings and investments.
And here you can see exactly how this works in the real world. Doesn't matter if you earn $25,000 or $50,000 a month, the principle is exactly the same. And that 20% slice, that's the part we are going to put to work for you. Okay, now hold on. Before you even think about investing a single rupee from that savings bucket, there's one more step. You have to build a safety net. We're talking about your emergency fund. And listen to me on this. It is absolutely non-negotiable. And why is it so important?
Well, because life happens, right? It's unpredictable. A job loss, a medical emergency, a last-minute trip. These things can completely derail your financial plans. This fund is your personal savior. It's what gives you the peace of mind to invest for the long haul, so you don't have to panic and sell everything when life throws you a curveball.
So what's the goal here? You want to save up enough cash to cover 3 to 6 months of your essential expenses. That's the needs bucket we talked about. Once you have that cushion built up, then, my friend, you are ready to start building some serious wealth. Okay, so let's recap. You've got your budget dialed in, you've built up your emergency fund. Now we get to the really exciting part. Let's talk about where you can actually put your money to make it grow. For most beginners, it really boils down to two main choices. First, you've got direct stocks. Think of this like you're the chef in the kitchen. You're picking every single ingredient yourself. It takes a ton of research, and it's higher risk. Then you have mutual funds. This is more like hiring a professional chef. They create a perfectly balanced meal for you by investing in lots of different companies. It's automatically diversified and generally a lot less risky. Now, the absolute easiest way to start with mutual funds is through something called a systematic investment plan, or SIP. And the best way to think about this is like an EMI, but instead of paying off a loan, you're paying yourself first. It's just a fixed amount that gets automatically invested for you every single month. It's a game changer. And the best part? Getting started is so much simpler than you think. Seriously, it's just a few steps. First, pick a platform you trust. Make sure it's SEBI registered, has low fees, and a simple app. Second, you do your KYC online with your PAN and Aadhaar. Takes just a few minutes. Third, you select a fund. A great place to start is a simple Nifty 50 index fund. It basically just invests in the top 50 companies in India, so you get instant diversification without any guesswork. And finally, you set your monthly SIP amount. And get this, you can start with as little as 500 rupees. That's it. It's that accessible.
Of course, you've got other options out there too. You have fixed deposits, or FDs, which are super safe, but the returns are pretty low. You have direct stocks, which we talked about, high risk, high reward. And of course, there's gold, a classic way to protect against inflation. But really, for most people just starting out, mutual funds hit that sweet spot, the best balance of potential growth and manageable risk.
All right, this is the moment. This is where everything we've just talked about comes together. We've laid the foundation. We've picked our path.
Now let's see the incredible, mind-blowing power of all this in action. Let's do the math of becoming a millionaire.
Let's start with a number that's totally achievable. Let's say you earn 25,000 rupees a month. We use our 50-30-20 rule, so 20% of that goes to investing. That works out to 5,000 rupees a month. Okay, that's our magic number.
Now I want you to just take a guess. If you consistently, diligently invest that 5,000 rupees every single month in an SIP, what do you think it grows to in 10 years? What about 20 years? Or even 30 years? The answer might just shock you.
Okay, prepare yourself. The results are, well, they're staggering. After 10 years, you'd have almost 18 lakh rupees. Not bad. But if you stick with it for 20 years, that number balloons to over 1.2 crores. And if you let that magic of compounding do its thing for 30 years, you are looking at an unbelievable 6 crores. Yes, 6 crores from just 5,000 rupees a month.
And here's where you really see the magic. Over those 30 years, the total amount of money you actually put in from your pocket is 18 lakh rupees, but your final corpus is 6 crores. Think about that. The vast majority of your wealth isn't the money you saved, it's the money your money made for you. That, right there, is the power of compounding and starting early.
Now, of course, we have to have a quick reality check. These incredible numbers are based on a historical average return of around 12.25%. The market goes up, the market goes down, so these returns are never, ever guaranteed. And that's exactly why it is so important to always do your own research before you decide where to put your money.
So let's be really clear about this. In today's world, investing isn't some luxury option for the wealthy. It's an absolute necessity for every single one of us. You now have the knowledge, you have the tools at your fingertips, and most importantly, you have time on your side. So the only real question left is, when are you going to begin?